This is episode 91 of the Andrew Hines Real Estate Investing Podcast. Welcome to episode 91 of the Andrew Hines Real Estate Investing Podcast. Today I have Cherry Chan on the show to talk about accounting for real estate. In this episode, we went through a bunch of questions that were submitted by my followers on Instagram, as well as questions that I had myself for Cherry, and just got the goods as to what we need to be thinking about from an accounting perspective right here and now at the end of 2020. Going through this lockdown with the various different government benefits that are available. So what we should be thinking about. And then we also talked about strategies. Should we be incorporating or should we be building our portfolios in a personal name? And then also talking about the implications from a mortgage standpoint there as well. So we get into a lot of the goods here, and I know you're going to want to catch this episode. So thank you so much for tuning in. Just a quick reminder that if you're new to this podcast, I highly recommend going right back to the beginning. This podcast started in February of 2019, and the episodes are still incredibly valid today. So there's been a lot of highly qualified, highly accomplished investors that have come on and shared their stories, and you should absolutely have an opportunity to benefit from that. It's free. It's all there for you. Head on back to episode 1, and I know you will be glad that you did if you have not already. And then final request, if you haven't already done this, could you please take a moment and rate and review this podcast on Apple Podcasts or whatever platform it is that you use. It just helps more people to find the podcast, and it helps it to grow. I would really appreciate it. Thanks so much, and please enjoy episode 91 with Cherry Chan. Hello and welcome to the Andrew Hines Real Estate Investing Podcast. I have Cherry Chan on the show today, long awaited. We have another CA on the show who can answer some questions and of course talk about your real estate investments. So thank you so much for coming.
Thank you so much for having me.
Yeah. I'm glad we could finally put this together.
Yep.
And I've got so many things to ask you.
Okay, great.
You're busy. Like to start off, like as far as I can recall, you have a book, right?
Yes, I wrote a book.
So
and then I'm coming up with a second one I'm hoping to release it by the end of this month.
Okay. And
yeah.
What are your books on?
So the first book is called Complete Taxation Guide to Real Estate Investing. And so it's pretty much just for Canadian real estate investor who need to learn the basic knowledge about what you are eligible to deduct and what you're not, and common corporation structure and how it can help you lower your taxes. And typically that's what the first book was about. And the second book was a more real estate agent focus. So I wrote it for real estate agents.
Okay. And then you also have, I think you have a bookkeeping course, which I found out because I was actually planning to make one and someone's like, oh, Cherry has one.
Yes, we did do a quick and dirty, easy to understand QuickBooks Online course. It is very basic, but it is a good starting point for people to get some hand holding to guide them through how to set up the initial QuickBook as well. Because
that is a little challenging, right? I think QuickBooks is kind of the industry standard, not for real estate investing, but just for everything.
Yeah, absolutely.
And I like it. But for me to tell somebody how to use it, if they didn't, because I have a little bit of an accounting background, I studied it in school, so I understand the basics, and I'm not sure every real estate investor would. So they do need a bit of hand-holding, I think.
Oh yeah, absolutely. We made it so basic that all they need to do is just to record their expenses and income. And at the end of the year, the goal is to have their accountant to look at it and do the rest. But at least the bare bone basic, it's already there. So
would part of your setup include entering the properties at their asset value and separating land and building and all that stuff, or do you not go that far?
I don't think we went as far as that.
Just record your expenses, tag them to a location, and we'll set up the rest.
Yes, exactly.
Okay.
Yeah.
That is the simple way.
Yeah. Oh, yeah. We want it to be simple because if you track, for example, mortgages, right? Mortgages are for
every month,
for every month, and every month there's a different breakdown for interest and then also principal. It's just hard for them to understand how to do the journal entry. So
yeah, I do track that on mine.
Yeah, that's
but I'm
awesome.
just like, I'm such a perfectionist. I want to know exactly what my mortgage balances are every month. It's a little bit of a pain, but I kind of have a system for it.
No, that's awesome. Yeah. I don't even know how much I owe. I do that only online.
Oh, okay. So
Actually.
you don't bring that onto your QuickBooks.
No.
Okay. We're going to get off of the QuickBooks conversation now. Anyways, I could nerd out over this stuff for hours. So Cherry's obviously a wealth of information here, and we're going to talk CA questions in a minute here. But just for context, because the rule is on this podcast, you got to be a real estate investor.
Yep.
And obviously you and Erwin are. So
Yeah.
Erwin is your husband. He was on back, I think, episode 38 or 37. But for those and things have probably changed. So tell us, what's your real estate portfolio look like right now?
Currently, we own our own home, and then we have 3 properties out in St. Catharines, and we have, I believe, 4 properties in Hamilton, and then we also have a townhouse in Toronto, and then we have one house, our office condo as well.
Okay.
Yeah.
Office condo. Oh, okay. So it's like a live-in work condo, or just a work? Or
No,
just
it's
a work
just
unit?
a condo. It's
Okay.
a unit, and then half of it is rented out. So we do our own office hacking as well.
Oh, okay.
Yeah.
And is your office here in Burlington?
No, it's at Oakville, at
Oakville.
Trafalgar and QEW.
Oh, okay. I thought you were Hamilton based, and okay, I had it all mixed up. And then you live in Burlington, which weirded me out because Erwin's license plate says Mr. Hamilton. I just figured.
I know. Well, Mr. Hamilton license plate was a gift from me when I first met him, because
Okay.
he named himself Mr. Hamilton.
Yeah.
We moved to Hamilton in 2013, downtown Hamilton, right by Hess Village. So for those of you who don't know where Hess Village is, it's where the bar area is.
Yeah.
So we got people coming into our fence to take away our stuff. Our patio chairs were gone while we were on vacation. It's a nice area and transition area, but it's not an area that I could raise kids, and that's why we moved.
So you moved. Yeah. Hess is a zoo, to be put politely. Fun when you're young.
Yeah. Oh, yeah. You have to
But-
be young to live in that neighborhood.
Yeah. People do some pretty ridiculous stuff down there. So
Yeah.
even coming from, I did the whole London bar scene, but I went to Hess and I'm like, what is going on here?
Oh my God. There was one time I remember it so clearly that we went out just for walk over to Jackson Square just to, maybe, I don't know, around 10 p.m. Wasn't really that late. And I see girls with half of their bottom showing. And that's just way beyond what I'm comfortable with. Yeah.
Yeah, they haven't quite matured in the classiness side of things. In some cases,
Yes.
not at all.
Yeah. For sure.
Yeah, obviously Hamilton's an interesting market. You've got pros and cons there. Okay, so you moved out of Hess Village. You've got your portfolio there. Are you guys? What kind of stuff are you guys invested in Hamilton?
They're mostly legal duplex.
So you did the conversions?
Yes, we did the conversion, and we have one student rental as well.
Okay. And for your average property in Hamilton, are you actively going back and refinancing them up to 80%, or do you kind of just let them build up equity?
We did what we could. And recently, we just discovered that we could potentially move some of the properties to my corporation. That then free up some of my personal credit to allow me to borrow more, to purchase more. So that is a process that we're going through right now.
Okay, so let's talk a little bit about that. And I think what you're referring to is if you move them to a corporation and then finance them commercially, you just reset the clock more or less.
Exactly. Yeah. So I do. We're in the process of transferring all 3 properties into the corporation.
Okay, so you're going to pay the land transfer tax on 3?
Actually, all of them are owned in trust for the corporation, so there is no land transfer tax to begin with.
Okay, so they were in trust, so you're just going to
Yes.
actually roll them in. So
Yeah.
I'm in that position too, where I could roll all my personally owned properties into a corp, but just the bill for land transfer just makes me not want to do it. But I want to reset the clock on myself because I'm, for some banks, I'm tapped out.
Oh, yeah, exactly. So I was asking one of the banks to see if they would take me on because it was another bank that gave us 5 mortgages, but all based on my personal income. And now if I were to refinance any of these properties, they would not give me more money.
Right.
But 3 of these properties were owned in trust for the corporation, so I could just move it over to the corporation and then refinancing a different bank with a different bank, own it in trust for the corporate, own it directly in the corporation's name at the time of closing. So then they remove the whole I guess, the whole mortgage off my credit report.
Yeah, that's the nice thing. And I've noticed it, and somebody who's done this more can tell me. But in my experience, when the corporation holds the properties, you don't see it on your personal credit bureau.
Yeah.
Which means it doesn't go into your application when you're applying for more mortgages.
Exactly.
So that's a really nice feature. And had I known what I know now, I would have probably built portfolio differently.
Absolutely.
Certainly, you can speak to the tax advantages to owning personally because you don't pay that ridiculous 45% tax in the corporation.
In the corporation, you pay like depending on what you do. So it's opening up a can of worms. Do you want me to go there?
We're gonna open that can of worms. But I mean, am I correct in saying because it would be considered passive for just owning a property inside of a corporation, that would be considered passive income?
If you earn rental income specifically, yes, it is considered what commonly known as passive income. The tax term is called specified investment business income, which includes interest income. It includes rental income and dividend income as well.
Right. Well, you can do tax-free dividends though from a corporation to a corporation, right?
Depends. They have to be connected corporation, meaning one corporation has to own the shares, at least 10% of the shares of the other corporation. Right. Yes.
Yeah. Okay. So that's how I do with my companies because I have the operating company and I pass the dividend up to my holding company tax-free.
Yes.
Okay. So good to know I'm not breaking any rules.
No,
there.
You know a lot already. You know what kind of questions to ask.
I've been thinking about these. So we're gonna dive in because and these are I like to hear what different accountants will say, right? So I'll talk to one because I mean some people it's always a working interpretation for some of the stuff.
Oh yeah.
Because you have to interpret the way it's written and how that might differ based on who's reading it. So we do have some questions, and I think we might as well just get into them.
Sure.
I got some people asking questions on Instagram, which I'm going to pull out right now, see if I got any new ones here.
For the record, I have no idea what these questions are.
And that's the way we roll on this show. There is no being prepared because you never know what I'll ask or what the guests will ask. Anyway, so we've got a couple here. Okay, so can you deduct cost of training, mentorship, seminar fees, against rental income? So this is one of our guests, or one of my Instagram followers asked that question.
Okay, great question. So training, mentorship, as well as coaching and membership, I would always group them under the same category. Typically speaking, the Income Tax Act has this general rule, and the general rule says that if you are earning a specific type of income, you're eligible to deduct the expenses that you incur for the purpose of earning that particular income, subject to a bunch of exceptions.
Right.
Okay. So membership, coaching, and all these expenses fall under that general rule because it's not part of the exception. The key here is to make sure that you take action, and depending also depends on the rental income that you're reporting. So for example, for someone who bought one property or didn't buy any property, go on coaching and didn't do anything for years and years, and then all of a sudden you say, hey, I incurred that cost 2 years ago and now I'm finally buying my first investment property. You need to be able to establish that correlation. And that the correlation is the strongest when you take action immediately after you incur the expense. So that's number one. Number two is that if you're reporting rental income that's very small and you're deducting a large expense, some of these coaching expenses or membership are $20,000, $30,000. You're incurring the expenses. Yes, you have a reason to deduct it, but chances are you're likely going to trigger an audit. And then when you trigger an audit, it's not black and white. Because remember, it's general rule. So you have to establish your case for your deduction. And the auditor would have their own standpoint and saying, hey, you did not incur $20,000 just so that you can buy a rental property. It's up for argument. So all these factors would come to play. And typically, I help my client to position themselves to take the deduction, maybe not immediately, maybe over a number of years as well, depending on the amount and depending on how much rental income they're reporting.
Right.
But on the other side, if they're doing flipping and the course is about teaching them how to flip, then that's a different story, right? Immediately you're taking
more
action.
Active business.
Exactly.
Makes more sense to have active training for an active business, maybe. Okay.
Yes.
Yeah, because rental income is looked at a little bit differently, I guess.
Yeah, exactly.
Okay, yeah, that actually makes a lot of sense. I like how you explain that. So,
good. That means I passed the first test.
Pass the first test. Don't worry, there's many more. Okay, so how to properly account for properties with JV partners. And I'm sure we could build more than just the accounting side of this into it, because there's your legal structure as well.
Oh yeah, joint venture is probably the toughest accounting part that we would have to deal with. When we talk about joint venture, I think it's it's an umbrella statement. There are different forms of joint venture partnership, different form of or different strategies in real estate. Some people do flips with joint venture partners. Some people just do long-term buy and hold. Now, typically, a lot of my clients would buy a property with a joint venture partner, and it's usually 50-50, meaning there is a money partner that would pay for the down payment, qualify for financing. And there is a sweat equity partner who does everything else, but would also get 50% ownership of the property.
Right.
So it's important to make sure that you account for everything. So that means including at the beginning the initial down payment, who pays for what, who's going to pay for the renovation upfront if there is any that needs to be done, and at refinancing, what would happen at refinancing. You have to specify in the agreement like who's going to get the money first. Sometimes it goes back to the money partner first, and then all the cash flow, who's going to report the cash flow. That's very important, because I have some clients whose JV partner didn't know that they have to report 50% of their income and expenses, and I have clients who form a joint venture. They call themselves forming a joint venture, but never sign any agreement. Yeah. Don't know how to split their income, and it makes our job really difficult.
Right. Yeah. So if you have say a client that said in their agreement said that the one partner that put in the money will get all the cash flow.
Yes.
With the exception of a certain amount, that will change how you account for it.
Yeah.
Oh man, that would be messy.
Yeah. So like some people would say, okay, I'm the joint, I've seen joint venture agreements saying that, okay, the money partner will take all the cash flow, all of it. So then the sweat equity partner, the real estate expert partner himself takes nothing.
Yeah.
I also want to caution, so in that case, then the joint venture partner is supposed to report all the income and expenses during the term, because you're getting all the cash flow.
Right.
And at the end, when you sell the property, the capital gain is 50-50.
Right.
So then that's how I would account for it. But that has to be specified as well in the agreement.
Yeah. So in other words, you would likely be doing up the return for that property and would communicate with the accountant that's handling the other person. Or if you're doing both, you could help prepare both to make sure that they both basically account for all the income and all the gains in total, so that there's no surprises down the road.
And then also there's also a part that I found it's very important is that just don't undersell yourself. A lot of my clients would start off by forming a joint venture partner left and right. And they buy lots of properties, but there is no money for them to live off. Yeah. Yeah. And I'm sure you've seen many investors that tell you that has hundreds of properties, but they don't live like they have hundreds of properties.
Yeah, because joint ventures is just right off the cuff, it makes it stickier to pull money out.
Oh,
even
absolutely.
If you're putting your money into a joint account, unless you've written these in detail.
Yeah.
When is it okay to start pulling money out? At what point, at what threshold do we say, okay, that's enough money in the account, now we can start pulling out everything after that? If you were partnered with me, we'd be talking 10, 15,000, but I know not everybody thinks like that. Yeah. And it's totally up to the person. So if I had a joint venture, I wouldn't even think about it as my money. It would belong to the venture, which I don't know. I find that helpful for savings, but that's another topic. But I don't spend my money for my rental properties because I think the account belongs to the property, not really to me. Whatever that property needs and belong to future properties that I might buy. So
one last thing that's very important in a joint venture agreement is that in case if you die, what's going to happen?
So you have to have that written out.
I know. I've gone through a couple of my clients who just passed away all of a sudden, and it's just really messy if you don't have that specified in the agreement.
Yeah, that's a great point. And one of the reasons that it just makes sense to get things on paper, doesn't matter how much you trust that person.
Absolutely.
It's just a risk that you're taking. Like if something happens to you, you don't want to leave that person with the burden of trying to figure it all out.
Yeah.
That's, great point. Okay, so tax deductions from rental properties that aren't as obvious. So this person's just asking for basically, what are some of the ones, maybe you can give us a couple of examples of less than obvious tax deductions for rental property owners.
So typically I advise my clients to take home office expense, assuming that they don't use their home for any other purpose, because when you take home office expense, you also need to worry about the trying to preserve the primary residence exemption on sale of property. So if you already rent out your basement, it's a bungalow, and you rent out your basement, and now you're also claiming home office expense, a portion of your home as home office expense, it may impact your primary residence exemption. So you may not want to take that. But typically, I advise my client to take home office expense, and you need to keep a floor plan of your home. If your home is 1,000 square feet, and the home office that you operate your rental properties portfolio out of is about 100 square feet, then 10% of all your mortgage interest, property taxes, insurance, utilities, and home internet would be tax deductible.
Okay, so. Now, I have a follow-up question to that.
Sure.
So my understanding is if I had, say, a duplex or a secondary suite in the basement, and say I lived upstairs, so 1,000 square feet up, 1,000 square feet down, we'll just say for simplicity. If that's roughly 50-50. 50 is my personal, 50 is rental property. So when I sell that, would I be 50% exempt from capital gains, and then 50% I would have to pay capital gains on?
So if 50-50, chances are yes, but then if it is, depending on how much you claim it as well, right, what you show, it's almost impossible to be 50-50, because you also, like there's utility room. So in the basement, and it's
so it might be 60-40 up,
it's
down.
more like 60-40. If it is 60-40, I would try to push it to not report the 40% capital gain, but there are certain rules that you have to comply with to qualify that. To preserve the primary residence exemption, you have to primarily use your property for the purpose of residence.
For being your home.
Yeah. So if you rent out 40%, is 40% a significant portion that would push you over the bridge? There is no written rule saying that 40% is too significant or 50% is too significant. But obviously over 50% definitely is a no.
Okay.
Well,
it seems to be definite.
Yeah, it would be
reasonably
definite.
You would assume.
Yeah, exactly.
Yeah, you would hope that the CRA would exercise reason. I would argue sometimes against that, but we'll go on that assumption.
Sure.
Anyways, okay, so we got another one here. Can I still get mortgages in my name if I incorporate? So I'm not sure the wording of that question. The mortgage would be in your company's name for the person asking that question. So as far as getting mortgages in your name, of course, you would be able to on properties you personally buy. This is just from the mortgage world. Cherry, if you had anything you wanted to adjust to that, by all means.
Recently, I did write, I think that person, I'm trying to interpret that person's question. I think the mortgage world is educating us, at least the traditional mortgage broker channel. Typically, everyone tell us that it's impossible to get mortgages in the corporation's name. But I was told that it's possible.
It is.
Yes. So you can just go to the bank and get it.
Yeah.
You can. So if it's my clients, I typically tell them to, if you are okay with it, just go to the bank to get your mortgage directly in the corporation's name. There is a workaround. If you can't get mortgages with the corporation, you can't, then you can own the property in trust for the corporation. There is that concept called trust, beneficial ownership, legal concept. And I'm not a qualified lawyer to explain to you what the beneficial ownership versus the legal ownership. But what I can tell you is that you from a purely tax perspective, if you have the proper documentation, such as a trust agreement, you have the funds flow through the account, the corporation, and have the corporation report all the income and expenses, even the initial purchase of the property. According to the tax law, we accept CRA accepts beneficial ownership, so therefore you can own the property in your personal name in trust for the corporation, and the corporation can report all the income and expenses.
Yeah, that makes sense. Now, I mean, from a mortgage qualification standpoint down the road, that creates something to tweak
that's what we talk
the
about.
underwriter's eye.
Yeah.
That's not something I would want to have in my portfolio a lot of, just because it creates future questions and future problems.
Yeah.
I've definitely heard of it. I've seen it. I've had clients do it back when I was doing mortgages. Here's a little tidbit I'll give you. I like mortgage brokers, especially ones that understand rental properties. However, say for instance, Scotiabank, back when I was doing deals, I couldn't submit a company deal to Scotiabank.
Yeah.
It couldn't be in a company. However, that client could go into the bank and do it in a company. Two different standards. So they have a different standard through the broker channel than they do retail banking. And I mean, I'm grateful for my time in the business because I understand these things. I think it's not a mortgage broker's job to be free or to only get paid by the bank. I think if a mortgage broker has the ability to tell you these things and educate you and guide you, they may or may not choose to charge you a broker fee to refer you out, or I don't know how they do that to get compensated, but it's kind of a conflict of interest in the industry.
Oh yeah, absolutely.
In that brokers don't want to send you away because they want to get paid.
Yeah.
But the second they tell you to just go over to Scotiabank direct, there's pros and cons to that. One, you could get any person working in the bank that day. They might not be good.
Oh yeah, absolutely.
And they might tank your deal because they don't know what they're doing, which is why we like mortgage brokers. So it's a delicate balance. I don't know if you have any, like you're in the industry quite a while now as an investor. Do you have any thoughts on that, or how do you deal with that conflict that brokers have?
Well, I mean, it's been like, I wasn't really in the mortgage industry, right?
No, but you're in the real estate investing industry.
So
yeah.
I have, it's funny how I just discovered this thing about a few weeks ago, maybe a couple months ago, I should say. One of my team members, my good friend as well, she when she started investing in Kitchener, Waterloo area, she went out and she bought everything in the corporation's name. So she qualified under, if you're familiar with it, the CIBC program, she qualified using her own income.
Right. So they still use her income?
But
okay.
but they bought it directly in the corporation's name.
Perfect.
And it's all purchase plus mortgage.
Mm-hmm.
So it was like 2-3 in the corporation's name, and then they hit a wall with CIBC, and they're then down to like 30-40% loan to value subsequent to that.
Yeah.
So recently they were trying to buy fourth property in Kitchener, and they went to a traditional mortgage broker, and they said, hey, like, I don't see any of your mortgages that's registered with CIBC in your personal name, and now I can just use your own, like, as if you are a mortgage version again, then we can finance your next purchase with 20% down.
Yep.
And I thought that was really eye-opening, because you could have gone to a different route, and then you are able to borrow more later on.
Yeah, it's compartmentalizing. I had Carmen Campanero on here a few episodes back, and she mentioned that's what she would do. She'd have a corporation for each property, and then that corporation owns the property. And even if there is a personal guarantee on there, the banks don't really ask about that. If it's not on your personal ownership, then they don't really bring it into the equation. And whether that's just a loophole that we're currently getting through, and that will eventually be closed, I don't think enough people are doing it that they'll close that loophole. It's a great opportunity right now.
Absolutely.
Sucks that I didn't learn this sooner, because I don't want to pay the land transfer. But that's part of this game, right? You're constantly learning. I mean, I look at it now for mass acquisition. I'd be looking at, in a corporation, buying packages of 6 properties at a time. And then I'd eventually just go credit union or commercial financing with multiple doors. So, and then the sky's the limit. They like lots of doors. As long as you meet their cash flow requirements, they like lots of doors. Key thing, you got to get cash flow. Otherwise, it's not going to work.
Oh, yeah, absolutely.
Yeah. Unless you have some unique strategy. I'm sure there's somebody out there with a unique strategy I'm not aware of. Okay. So Andrew, can you please ask Cherry? Okay, can you create a property management company to take care of your own property investments, mostly for tax deduction purposes? And so if I create a rental property company to take care of my own personal investments in London, can I deduct business expenses such as utilities, my home's mortgage? I think he's talking about writing off some of his own personal home office expenses. Yes. And then he says, also, so a separate question. We'll start off with that one. So he's talking about it sounds like a tiered company structure where you create a property management company to manage your rental properties.
Yes.
Is that, I know people used to do this like 10 years ago. Do they still do this?
I generally don't recommend my clients to do that because it's just because it's a lot of paperwork involved and the money has to sit in the corporation. So just using, I guess, your audience background story, if you own properties in your personal name and you just create a property management company, yes, you can do that and have the property management company charge your personal rental portfolio a management fee. It is possible to do that, but the problem is that there is no tax saving unless you keep the money in the corporation. Mm-hmm. There is something called tax integration. If you just take out everything that's inside a corporation immediately in the same taxation year as you charge the property management fee, there is no tax integration, tax saving whatsoever.
You're not saving anything.
Exactly. The accountant makes the fees, but then other than that, you're not creating anything for yourself, right? Yeah.
So the logic behind that is you charged yourself. It went into the company pays a 15% or 13% tax rate. And then you pay tax on the dividends when it's dividended back to you.
Exactly.
So you're not really saving anything.
No, nothing. Yeah. Now, but then maybe you're the one that do not need the cash.
Yeah.
So then maybe there is a reason to leave the cash in the corporation. Yes, you save the taxes, but then what are you going to do afterwards with that cash sitting in your property management company?
Perhaps if you wanted to start buying properties.
Exactly.
Like you could dividend that money up to your holding company and then lend it back down to an active investing company.
Yeah, something like that. Then it's really up to that person. And then if you are talking about owning properties directly in the corporation, real estate holding company, and then you also set up a second property management company. Yeah. So in that case, it gets a little bit more complicated, especially if different owners are involved, because right now, in 2017, the federal government came out with the new tax on split income rule. So it gets a little bit complicated. It may not be a good idea to do dividend at all when the property management fees are coming directly from a related company.
Oh, okay. So are you saying that they might look at your income differently, or they wouldn't allow some of your deductions?
When you draw the dividend from the property management company, they may tax it at the highest tax rate.
Oh, okay. So in the corporation above.
Yeah.
Okay. So here's what I think he was getting at, and I've talked about this before, and I'll just ask you because it's in my mind the reason people would do that structure would be they want to get down to the active income tax rate on the property management company at whatever 13% versus the 45 highest, and I'm ballparking these percentages. So passive income rental, 45, no one wants to pay that.
It's 50%.
Yes, okay, that's
50.
Ridiculous.
Yeah.
So no one wants to pay that. So you'd rather be active. Does it work for that? If I want, so say I have 5 properties in a corporation, and then I set up a management company to manage those 5 properties. Can I charge that property management even though it's all related at 13% active income tax?
Yes, you can.
Yeah.
The problem of that arrangement is that it's not about the setup. It's about the actual work that you do. The property management company is really operating a business, and it does the work for the real estate company. And if you do that, a proper business means that a proper property management company means that you will have to issue the invoice, have the money coming in, and you have the proper documentation to prove that you are an independent business. It's not just set up for the purpose of tax filing. The money has to change hands. There has to be management agreement signed, and property management fees being charged has to be reasonable. So all these things has to be done. It sounds easy, but when it comes down to, charging every single month, having money changing hands every single month, not everyone can do it.
A lot of work.
Yes, exactly.
Yeah, it's a lot of admin.
Yeah, so then to some people, it's not worth it.
So you can do that reasonable fee. I mean, reasonable for property management is getting up there. Some people charge 12%.
Yeah.
So it could be a substantial amount.
Yes.
But would you need to also have independent clients for property management as well if you wanted to protect yourself?
Well, ideally, yeah. In the perfect world, you want to have.
Because then you can kind of legitimize your business.
Yes, it
and
is
your claim
your
to be able to go as active income.
I think I've done a couple of clients whose property management company actually lose money. Mm-hmm. So it kind of defeats the purpose of setting up the property management corporation, to be honest.
Yeah.
I have to guide those clients up to like, hey, like you can't deduct as much in here. If you think about it, people don't understand that, for example, the home office expense that we mentioned earlier, you can still deduct it against your rental portfolio. It's a direct deduction there. Why don't you just deduct it over at your rental portfolio and
deduct the home office expense.
Exactly.
Yeah, the other thing, so I have one property in a corporation. I should have done more, but what I've done to kind of avoid paying tax is, I'd max the capital cost allowance deduction.
Exactly. Yeah, I do that.
And I don't claim an office expense against that company, but that's because I take it in another company. Exactly. So I don't want to get myself in trouble by double dipping. Yeah. Just are there any thoughts on that matter of things people should avoid? I mean, obviously double dipping is one of them. Is there other things that come into your mind?
Like for example, we all like to pay cash for the contractor work and not get a receipt. That's probably not a good idea. And then there are people that do pay cash and then still create a receipt on behalf of the vendor, the contractor. Also not a good idea.
I have done that in the past, but I got the contractor to sign it.
Okay, so then that would work.
But I'm like, you don't have a receipt on you? Here we go. You're going to sign that. Yeah. Very, very important, right?
Exactly.
Yeah. Okay, so I have some ones that I specifically put in here. We're going to get into it. The first one is a doozy, and the other ones get a little easier. So first one is HST. At what point do we look at substantial renovations where we would have to charge HST on, say, an additional unit that you're creating, or when you're renovating an existing property and refinishing it?
So HST is a complicated thing. I think for the most part, people don't reach that 90%. And when we talk about let's just backtrack a little bit. When you purchase a resale home, so someone used that home before, you don't need to pay HST. But when you buy it and you then spend a fortune in terms of renovating it from top to bottom, there is a chance that when you do that, you have to charge HST on the resale of the home, because now the house is considered in the eyes of the Excise Tax Act that it's being substantially renovated and it's practically a brand new home. Now, what's considered substantially renovated, and it is called 90%. So typically 90% of the house is renovated, either counted by floor space, wall space, or both of them. Then you have to count that 90%. Is it 90% or not 90%? And then document from there.
Right, yeah. And then there comes the gray area. Where do we define 90%? Yeah.
Exactly.
Yeah. This is why HST is a very specific topic. So
if the more documentation you have, the more pictures that you have, the more flooring or drawing or plans that you have, the better it is. It is quite difficult for CLA to go after that substantial renovation right now. It's hard to know.
For them to prove it.
Yeah. CLA's focus is on HST on new build. Yeah. That is what they are going after at this moment. For the last probably 6-7 years now. Okay, so they're really for people who are doing self builds and not assessing HST or not. Or for people who think that they can claim HST rebate. And claim it, and then decided not to charge HST later on. So those would be... Okay, those are the main targets now. Good to know, right? Because it's all about who... they're kind of a predator, so who they're going after. Sorry if you work for them. The HST part is... Okay, next question. What do you think about a golf membership? Could my corporation pay for my golf membership? These are tough questions. Yes, your corporation, you can use corporate corporation fund to pay for the corporate owned membership.
Right.
But then the thing is, you cannot deduct any of the fees. You can deduct the meals that you take your clients out and entertain them, only the meals portion of it. But if you pay for your clients' green fees, they are not deductible.
Okay, so say, I don't know, like say $3,000 is a fee. I think that's probably low, but for one season.
Yeah.
So that's a membership for one season. You're saying it could be paid with corporate funds, although it wouldn't appear on an expense line. It would be after tax dollars in the corporation.
Yeah. So there are two things that we're talking about. Like the first thing is the financial statements. The financial statements are done for the purpose of the user, which would be you.
So those wouldn't be in the tax version.
Yeah. So then that would be like looking at normal, just a regular deduction. But when we prep your tax return, we would add it back to your Schedule 1 in your T2 corporation tax return, and so it becomes part of your taxable income, so you can't deduct it.
Okay, so it's subject to 13% or whatever the income tax rate is for my corporation.
You can't deduct it, yes.
Yeah, so I'm going to pay tax on that amount of the income.
Exactly.
So it's not deducted. Okay, but that's still better than, dividending it out to myself and then paying it personally.
It's important to have the ownership clear though. So make sure that it's your corporation owning the membership.
So my corporation's name should be on it?
Yes.
Does that mean that I have to ask the golf course if more than one person from my corporation
one? Oh no, so typically no.
They'll put my corporate and the, okay.
Yeah.
All right, so that's good to know. I'm kind of doing some planning for next year right now. Okay, so tax benefits, or what do we need to know about this whole lockdown situation and what the government is offering? I know we're late into it, but are there things that real estate investors can benefit from, special credits, or maybe it's more just business owners?
So there are two things that people are real estate investors or even real estate agents, they are benefiting from, or they could possibly be benefiting from. The first thing is the SBA Long. So it's I think it's called Canadian Emergency Business Account, and it's a $40,000 loan that if you own properties in a corporation, you would probably be able to qualify, because it does require a business number, a business bank account right now, as of right now, and then you also need to have a $40,000 non-deferrable expenses. So non-deferrable expenses include mortgages, property tax, and insurance. So non-deferrable, because you can't delay those.
Yeah.
Or you could have $20,000 payroll in 2019. Then that would qualify you to borrow this $40,000 interest-free loan from the government. And $10,000 is waived if you repay this loan by December 2022.
Okay. Now, I haven't taken this in my corporation. I feel like I could.
Yes, you should.
I just haven't, because I don't know. I was just frustrated with this whole lockdown thing. I didn't want to participate. That's more or less where my head was at. Stupid, I know.
Many people took advantage of it and they just got approved. The use of funds is very important. It's supposed to be paying for the non-deferrable expenses. So it's not supposed to be paying, dividend to the shareholder. Right.
Well, I mean, in my company, it would just be paying for. It would literally just be liquidity. It's a construction company. So.
Yeah. So then there you go.
So that's okay?
Yeah.
I mean, I still pay myself dividends, but I like liquidity.
Yeah. Oh, absolutely.
Okay. So if it's tax-free, interest-free, I don't think I heard that part before. So maybe
it is interest-free.
So maybe I should apply for that.
And then $10,000 is waived if you.
So free $10,000.
Pretty much.
Is that $10,000 considered income then?
I would think so, but they haven't really talked about it.
They haven't, yeah. I mean, but normally you would, if something's like no longer due, then it becomes earned.
Exactly.
Yeah, okay. Oh, accounting. So much fun. Okay, so that's a good one to know. Real estate investors could take advantage of that. Anything else?
I mean, we're kind of late to talk about SERP. SERP ended. Okay. I think it's now changed to the EI, which has special type of format that I haven't really followed so far. And then for commercial landlords out there, there are rumors that I just saw that small business would be able to take advantage of and apply directly to the government to get the benefit or get the help they need, rather than to apply through their landlord. So before small businesses would have to have a drop in revenue for 70% and more or more before they would qualify under this commercial rent relief program.
Gotcha.
But that was for the last few months. Now the rumor is that because that program was so strict that nobody can qualify and very few people apply, so they're coming out with a new program.
Yeah, it's really unfortunate to see. Not that I'm trying to intentionally be critical, but just how many small businesses are not coming back because of all this.
Yes.
Super, super sad.
Yes,
I'm sure you're seeing it in your client base. A lot of them are just saying, no, that's it.
I am fortunate in a way. A lot of my clients, because real estate investors. Yeah.
So you don't have to see it as firsthand or secondhand, I guess.
We do belong to this entrepreneur organization, and a lot of you see a lot of people are having a tough time to come back and generate any revenue. So.
Yeah, it's quite the dilemma. I'm really hoping that we see a change in the way this is being handled. And, at some point we've got to let the market resume. Otherwise, we're digging ourselves a deep hole.
I know,
it's scary.
It's just so sad that the media has been only focusing on the number of cases confirmed every day. And 2 weeks ago, when I was talking to my team, I'm like, why are we not talking about the number of cases that do not need to be hospitalized and fully recovered? How many cases are actually hospitalized, and how many of them are in the ICU? And how many of them actually got better and got released, but then they don't talk about.
Well, that's context, right? And what's the damage being done by our approach? How many people will commit suicide because their business went under? And those are tough topics, and I don't mean to diminish, because I know this is sensitive, and my heart goes out to everybody affected by this, because we all are. And of course, some people have had family members become ill, and I feel so deeply for you, and I'm not diminishing any of that. I think we all, I like to say this, like, we all want what's best for humanity and might just disagree on how to get there. It's not that we want to be insensitive or anything like that. It's just we have to be balanced in how we look at this.
Well, I do have one client who committed suicide just because of COVID. I think it's directly.
So you've seen this?
Yeah, directly caused by COVID. And
it's depression too, right?
But the trigger was the COVID lockdown.
Yeah.
So before, I'm sure there was serious depression too.
It exasperates the problem, right? Like, think about alcohol abuse. There's so many things. Like, this is it's a can of worms to dig into.
Yes.
But this is what it is to be an adult, to be in a democratic society where we have to be balanced about our decisions and can't be one-sided and emotional. Which is easier said than done.
Absolutely. Like, I just wanted a little bit more context in the media rather than just focusing on the number of new cases found.
Right. Well, I mean, and I've been doing a lot of research on this, and I feel I've given the appropriate caveats here. That even the creator of the PCR test has reservations about it being used for this purpose. Has had discussions about how it amplifies a material, and we're getting, even Ontario's Minister of Health has admitted 50% false positive. So when we only talk cases, it's very deceiving. It doesn't necessarily mean somebody's infected. It could just mean the case triggered. And again, rabbit hole. But I think that we as investors, and I think a lot of us think business minded, and we think what's happening here and what is going to happen to all those that we care about in their businesses. So again, I really hope that we can all voice our opinions and respectfully, and hopefully if you feel strongly about this, contact your MP, contact your local governments, and tell them, hey, this doesn't work. we need to have some context, number one. And some progress and a plan. A plan would be great. Just a plan would be awesome.
Absolutely.
Isn't that the weird thing? We don't have a reasonable plan for resumption. It's crazy that this is the world we're in. Any questions that you can think of that I didn't ask you or no one asked yet? Like, what are some common ones you get?
The most common one is, should I incorporate? I think we cover a portion of that. Like, there are reasons to set up corporation because you can put the properties, mortgages directly inside a corporation. There's the legal liability protection. There is also the reality is that from a tax perspective, there are definitely flexibility in terms of tax sheltering. It's not necessarily tax saving immediately, but tax flexibility. Right now, I'm working on a retirement planning retirement plan for one of my clients who is considering retiring. She owns 3 properties in her corporation, and I would be able to sell some of these properties, the 3 properties in different stage, and then spread out the capital gain and the dividend over a number of years to pay to her. And therefore, from there, I would be able to lower their taxes rather than taking it all at once in the personal name. So those are the flexibility and advantage of having the corporation. Of course, then it comes to maintenance costs because there's annual tax filing. It's always a hassle to maintain a second bank account and a second legal entity, 100%. But so it's not for everyone, I get it, but it's worthwhile to look at the whole big picture, but rather than just thinking, okay, my accountant or like these people said that you need to have at least 3 to make it worthwhile. But a few people would say that the 3 has to be in the corporation to make it worthwhile. If you own the 3 in your personal name and then transfer it to the corp, then you lose out on the land transfer tax.
Yeah, I don't like that land transfer tax, but so I mean, in my mind, there's a trade-off. You have huge flexibility, you have huge ability to get a lot more growth and more mortgages. And then the negative is you're going to pay that hefty tax rate. You can offset it a lot with capital cost allowance, and then I believe something accrues. Does something accrue that you can get it back, I think? Yeah,
so the 50% is just a specified investment tax rate. Typically, we don't pay that. We claim maximum capital cost allowance against the rental income. Flips income, they're considered active, so they don't even fall under that 50%.
Right, just for passive.
Just the rental income. And when you are, when out of the 50% that you pay, if you do pay that 50%, 30% would be refundable when you declare a taxable dividend to the shareholder.
And so that would be refunded to the corporation?
Refunded to the corporation.
Okay, so they just get a check back from, you pay dividends, here's a check back.
Yes, so 50% minus 30%, so we're talking about 20% in the corporation that you're truly paying on the passive income. But you have to declare the taxable dividend. So if you do declare the taxable dividend, that means the shareholder, meaning the investor themselves, would have to report dividend,
and then you pay tax there,
you pay personal tax. So then you have to play around with timing, because if timing is off, then you're paying more tax.
So not simple is the answer there. But
nothing is simple in the Income Tax Act.
Which is why you need a good accountant, somebody who understands investing, which obviously you do, to help through this way. So I think the takeaway here is, work with a professional, work with somebody who can help you make these decisions, because they aren't easy. Realistically, they're just not, unfortunately. They should be. It should be simple, but it isn't. Thanks, Canada. Anyways, no, I am grateful to live here. I think we have a lot of advantages, so we'll deal with it.
Yes.
We'll deal with it.
Yes.
Okay, so Cherry, are you guys still looking for investments, or are you on the stock hacking route here? What's your investing strategy right now?
So we do have stock hacking going on. So we just finished a stock hacking course over the weekend, teaching people how to generate cash flow. I mean, I'm really blessed to find this stock hacking strategy on top of real estate investing. So I would not be where I am without real estate 100%, because there are many business decisions that I take. In the back of our mind, we thought that we're going crazy. Like, why would we take this? Including doing the conference last year. Hosting Grant Cardone to over 1,600 people. It's not an easy task. But when we did it, when we make the decision to go ahead, our thought was that, okay, worst case scenario, we sell a house. It's not the end of the world. We don't have to start all over again. It's just one house that we have to sell. Like if things didn't go great, or if you didn't make the money back. Exactly. We just need to do that. And so I'm forever grateful for my real estate portfolio. But then at the same time, I've also seen my mom's house that I often talk about. My mom's house is in Toronto. She doesn't live in Canada anymore. She has this rental property in Toronto that I help her manage. And this property had a flood 2 years ago. So we were renovating top to bottom, and then there was a pipe burst, and there was a flood, and the pipe burst happened on the second floor. So then the water came through the living room ceiling, and then go down to the basement.
So it rained in the house.
The entire house.
I've experienced that.
Yes, the entire house was flooded. It's a small house, but it still cost a fortune, right? And it cost her about 50 to 60 grand to fix everything up for rental. This house was fully paid off. When she bought it was $320,000. Of course, today it's like over $1 million.
Yeah.
She's only getting $2,000 rent every single month. After expenses, she's getting $18,000 net rental income. So she needs to save for 3 years of net rental income to pay for one major renovation.
Right. Yeah.
So, I mean, I have nothing against, I love real estate, and I think real estate is the long-term wealth growth strategy. There is nothing that could beat real estate. But at the same time, I think that there are other strategies out there that you could also use
supplement
to complement each other.
Yeah. Yep.
So let's use my mom's house as an example. That house is worth $1 million. If she sells it for $1 million, and I put it in the stock market, and that would give me 5%. 5% dividend. Yeah. So 5% on the $1 million is $50,000.
She's doing better than she is on her real estate right now.
Exactly. So
part of that is that she wasn't leveraged, right? She'd already paid off the mortgage. Exactly. If she was leveraged, her return on equity is better.
Yeah. So that $50,000, and she's in her retirement age, right? Yeah. That $50,000, if she has no other income, dividend income, Canadian dividend income, if you have no other income, basically is tax-free for the first $50,000.
50, yeah, okay. I thought it was 60, yeah. Okay, so 50.
Maybe close to 55.
It's in between there, yeah.
It's in between. Okay. But that's pretty awesome deal. Like if you have a couple that earns 100 grand tax-free, it's pretty amazing. Of course, like you have to play around with your own situation. I just thought that, hey, like this stock hacking thing provides certain cash flow, and it allows many of my clients actually quit their job because they have this income to supplement their life. So it's just one step closer to.
Yeah. And just real quick, so this is the simple part of this is selling put options on stocks. There's way more to it, but that's the simple version I got from Erwin in the books I read last year. So you're selling that, and basically you collect a premium, and then you might not ever have to buy that stock. Anyways, Erwin talked about it in the episode that we did.
Oh yeah, he did.
So yeah, he did talk about it a bit. So if anyone wants to listen to that episode, I think it's 37 or 38. And that was right before the stock hacker or the wealth hacker
conference,
which that was one of the topics. So you guys have gone way advanced into this, and I was picking Erwin's brain about it when we got together last. Lots more I need to learn about it. And that's probably its own episode if we want to dig into that a bit more, but because it's complicated. But
no, it's not for everyone as well. But it's just another strategy out there. Another tool that you can add to your toolbox.
Absolutely. So Cherry, how do people get in touch with you if they would like to connect? Maybe have you help them out with accounting? Where should we send them?
You can visit my website. Let me just try to speak this clearly because people you always get it wrong. It's realestatetextips.ca.
Okay.
I do a weekly blog post on real estate tax tips. Sometimes I update. I do some update on court cases that I've been reading up on. Sometimes I talk about the top 10 tax deductions a real estate investor should take. There are a lot of blog posts, a lot of resources out there. I've done, I would say, about 400 blog posts there in that database.
Yeah, you're always posting stuff, and it seems very interesting topics. I see them on the group, and that's definitely a value add.
Yeah.
Okay, so realestatetextips.ca, and I got that right?
Yeah, realestatetextips.ca. And if you want to follow me on social media, it's just Real Estate Tax Tips. That's Facebook and Instagram.
Okay, yeah, and I've got you on Instagram. So I will put those in the description. And then from an investor standpoint, just final words of wisdom to help people take it to the next level. You guys have obviously got a very well-established portfolio. You're doing it right. You've got secondary income. What would you want to leave people with as kind of a piece of advice?
We learned recently the entrepreneur organization that we are part of, that we need to have a big, hairy, audacious goal in our business. And to us, that goal is to help create 10,000 millionaires in the next 10 years with golden hearts. So to Erwin and I think the best, not necessarily the best thing, but the most important thing in our mind is that, yes, we make money, but doesn't mean that we stop there. We take care of ourselves, we take care of our families, but we want to step up, and we also want to help the less fortunate. On the way to golf today, maybe on the way home, he was telling me how he's going to give this send a card to one of our friends that we knew from CrossFit on her daughter. It's her daughter's birthday, but because of COVID, the daughter cannot get together with the friend. So then she's now feeling down. She's teenage years. So what Erwin did, instead of sending the card, his plan is to send a set of iPod. What's that called?
AirPods.
Yeah,
AirPods.
Yes, yeah. Sorry, AirPod.
Yeah.
I don't use iPod like AirPods. So he's going to send that anonymously.
Okay.
So just to have the financial resources to do things like that makes us really happy.
Yeah, that's super admirable. And I know you guys have the basket brigade.
Yes,
right?
we have our own basket brigade charity.
Yeah, so you have your own charity. You guys do a lot of stuff.
I know. Sometimes I wonder how we have all the time.
I do too. And you still have time for golf. So that's good. Hopefully we can get out again this year. That would be
absolutely.
That would be awesome.
Would love
so we're gonna try and set something up. But thank you so much for taking the time to do this.
Thank you so much for having me.
Thanks for tuning in to today's episode. Just a friendly reminder that the kindest thing that you can do if you're enjoying this content is to share it with somebody that you think it could help. I don't have a big marketing budget for this podcast. Everything is word of mouth. So your sharing this content means everything. Thank you again. I'll look forward to seeing you on the next episode.